Japan is not merely participating in the digital asset space, it is executing a deliberate top-down national strategy with the potential to redirect the global narrative of Web3 and cryptocurrency. This is the foundational thesis of our analysis. Unlike other major economies where crypto innovation often develops in spite of or in opposition to regulatory bodies. Japan presents a unique case of government-led orchestration. This strategy elevates the nation from being a significant market participant to a potential architect of the next market cycle's primary narrative. It is the critical first domino, setting in motion a chain reaction of capital deployment, infrastructure development, and cultural export. The core of this strategy lies in Japan's decision to leverage its undisputed global soft power, its cultural exports, as the primary vehicle for crypto integration. Government leadership, from the Prime Minister's office downward, has explicitly and publicly linked the future growth of industries like manga, anime, and video games to blockchain technology and digital assets. This is not a vague statement of support for innovation. It is a targeted industrial policy. By framing crypto as the essential infrastructure for the next generation of cultural content and its global monetization, Japan has provided a clear, tangible, and emotionally resonant reason for this technological pivot. It answers the why now and why here. Questions with compelling clarity. An official's recent paraphrasing of a famous anime line, "Stop talking and put your resources here," perfectly encapsulates this new assertive posture. It is a call to action directed at both domestic institutions and international capital, signaling that Japan is not just open for business, but is actively building a new business model. This cultural economic mandate is transformative for several reasons. First, it provides a cohesive national objective that aligns the interests of government ministries, corporate conglomerates, the keiretsu, and creative industries. Second, it creates a natural on-ramp for mass adoption. Millions of global fans of Japanese culture may encounter blockchain technology not as a complex financial instrument, but as an integrated part of the stories, games, and communities they already love. This fundamentally changes the user acquisition model from one based on speculative finance to one rooted in engagement and fandom. Third, it offers a defensible narrative against regulatory skepticism. Promoting cool Japan through technological means is a far more palatable political position than endorsing volatile financial assets. Therefore, Japan's plan is a masterclass in strategic positioning. While Western regulators grapple with classifying assets and managing systemic risk, Japan has sidestepped the philosophical debate entirely. It has instead framed crypto as a practical tool for national economic and cultural expansion in the 21st century. This reframing is not incidental. It is the central pillar of their approach. It provides the why that justifies the massive investments in infrastructure, the progressive regulatory frameworks, and the pursuit of global partnership. In essence, Japan is constructing a self-reinforcing ecosystem, using its culture to drive crypto adoption and using crypto to amplify and monetize its culture on a global scale. This dual-purpose strategy is what makes their 2026 timeline not just a prediction, but a tangible goalpost for a coordinated national effort. The national vision articulated by Japan's leadership would remain a theoretical blueprint were it not for the decisive, capital-intensive actions of its corporate titans. This second pillar of our thesis examines the critical translation of strategy into tangible infrastructure. Japan's unique economic structure, dominated by massive, interlinked industrial and financial conglomerates known as keiretsu, provides a formidable mechanism for execution. Unlike speculative venture capital common in the West, we are witnessing strategic, long-horizon investments from entities that control foundational sectors of the global economy: trading, manufacturing, and finance. This is not a bet on a disruptive startup. It is the systematic construction of a new industrial layer by the very pillars of the old economy. The activity is most pronounced in Japan's legendary Sogo Shosho or general trading companies. Firms like Mitsubishi, Itachi, Mitsui, and Sumida are not simple import-export businesses. They are vast, vertically integrated ecosystems that move physical commodities, finance projects, and develop infrastructure worldwide. Their entry into blockchain is multifaceted and deeply strategic. We see one launching dedicated venture funds to finance digital asset startups, effectively becoming a gatekeeper and incubator for the next generation of Web3 companies. Another is deploying blockchain for supply chain traceability, a move that solves a core business problem, provenance, and efficiency, while simultaneously building institutional expertise and real-world utility for the technology. Most significantly, key financial arms within these groups are actively developing and issuing regulated stablecoins on major public blockchains like Avalanche. This is the masterstroke. A stablecoin issued by a pedigreed Japanese financial institution is not just a payment token. It is a bridge between the trillion-dollar legacy financial system and the digital asset economy, providing the essential, low-volatility medium of exchange needed for real commerce and sophisticated financial products. This corporate build-out creates a powerful virtuous cycle. First, it provides legitimacy and risk mitigation. When a Mitsubishi or a Sumitomo stakes its century-old reputation on a blockchain initiative, it signals to the entire domestic market, from regulators to retail investors, that this is a serious long-term endeavor, not a fringe gamble. Second, it ensures interoperability and scale. These conglomerates have existing relationships with thousands of global suppliers, manufacturers, and distributors. Integrating blockchain into their existing operational software, like manufacturing execution systems, means the technology is being baked into the plumbing of global trade from day one, guaranteeing immediate scale and utility. Third, it attracts allied global capital. The participation of firms like BlackRock, which has partnered with these Japanese entities on tokenization projects, is a direct response to this infrastructure build. Institutional capital follows credible infrastructure. It does not pioneer it. Japan's corporates are building that credible foundation. Therefore, the narrative here is not of a retail frenzy, but of a quiet industrial revolution. The capital being deployed is patient, strategic, and aimed at capturing value across entire value chains. This activity provides the essential unsexy backbone, the rails, the payment systems, the legal frameworks upon which explosive consumer-facing applications, like the hypothesized super game, can reliably run. In essence, while the government's cultural strategy paints the compelling why, Japan's corporate giants are methodically solving They are constructing the industrial-grade runway, ensuring that when the cultural catalyst ignites public attention in 2026, the economic and technological infrastructure to support a true tsunami of value and activity is already operational and waiting. This seamless handoff from public vision to private sector execution is what makes Japan's position uniquely formidable. While ambitious vision and corporate capital are essential, they operate most powerfully within a defined and predictable legal framework. This is Japan's most potent and immediate competitive advantage, the third pillar of our thesis. In a global landscape where regulatory uncertainty acts as the primary brake on institutional adoption, Japan has methodically constructed a clear, comprehensive, and operational legal system for digital assets. This is not a promised future roadmap or a set of proposed guidelines. It is enacted law. This regulatory clarity functions as a powerful economic accelerant, transforming Japan from a participant into a preferred destination for global crypto capital seeking a safe harbor. The foundation of this advantage is legal finality. Japan's Payment Services Act, PACE, a significantly amended in recent years, provides explicit definitions and rules for cryptocurrency exchanges, custodians, and now, crucially, stablecoins. The country has established a licensed exchange system overseen by the Financial Services Agency, FSA, creating a gated but legitimate on-ramp for retail and institutional investors. More importantly, Japan has moved decisively on stablecoin regulation, passing laws that clearly define them as digital money and restricting their issuance to licensed banks, trust companies, and registered money transfer agents. This stands in stark contrast to the United States, where the regulatory status of most digital assets remains a subject of contentious debate and litigation, creating a pervasive climate of legal risk. Japan has removed this fundamental uncertainty, allowing businesses to build and investors to allocate capital with a clear understanding of the rules. This regulatory precision creates a self-reinforcing cycle of legitimacy and liquidity. First, it de-risks institutional entry. For a global asset manager, pension fund, or insurance company, the ability to operate within a known regulatory perimeter is non-negotiable. Japan's clear rules lower the compliance and legal overhead for these entities to participate, making it a logical first jurisdiction for Asian and global expansion strategies. Second, it attracts high-quality projects and talent. Developers and entrepreneurs are drawn to environments where the rules of the game are known, allowing them to focus on innovation rather than legal survival. This fosters a more sustainable and less speculative local ecosystem. Third, it directly incentivizes the onshoring of liquidity. With clear guidelines for token listings, Japan already has a formal framework that other nations lack. Projects are incentivized to pursue Japanese exchange listings to access a deep regulated pool of capital. This draws trading volume and market depth into the Japanese market, further solidifying its role as a liquidity hub. The strategic outcome is that Japan has effectively built a regulatory moat. By acting decisively while other major economies hesitate, it has created a first-mover advantage in establishing itself as the jurisdiction of choice for serious, long-term capital in the digital asset space within Asia. This regulatory foresight is the critical enabler that unlocks the potential of the corporate infrastructure build. Banks can issue stablecoins because the law allows it. Trading houses can tokenize assets because the legal treatment is defined. This transforms their ambitious projects from daring experiments into executable business plans. Therefore, Japan's regulatory environment is not merely a background condition. It is an active, strategic asset. It provides the essential plausibility engine for the entire national strategy. It assures both domestic corporates and international partners that the grand vision has a stable legal foundation upon which to build. In the race to define the next era of digital finance, Japan is not competing on hype alone. It is competing on the superior tangible grounds of legal certainty and operational clarity. This advantage will continue to funnel capital, talent, and strategic projects into its ecosystem, concentrating the ingredients necessary for a major market-moving event. While pillars of strategy, infrastructure, and regulation provide a powerful launchpad, history shows that mass-market crypto adoption is often ignited not by institutional frameworks, but by a singular, culturally resonant event that captures the global imagination. This is the role of the hypothesized supergame, the fourth and potentially most explosive pillar of our thesis. It represents the catalyst that could transform Japan's methodical top-down build-out into a viral, bottom-up global phenomenon. A blockbuster Web3 native game from a legendary Japanese studio is not merely a product launch. It is envisioned as a cultural and economic singularity, capable of onboarding an order of magnitude more users than any financial product ever could. The concept draws on the unique position of Japan's gaming industry, which is both a pillar of its cultural export strategy and home to studios with globally beloved intellectual property, IP, from iconic characters to entire worlds with decades of narrative depth. Executives from major firms like Sega have openly hinted at ambitious projects targeting the 2025-2026 timeframe, with one describing the goal as potentially the greatest achievement of their career. The critical distinction of a true super game in this context is its deep, native integration of Web3 principles. This would not be a traditional game with a tacked-on NFT marketplace. Instead, It would be architected from the ground up to feature true digital ownership of in-game assets, characters, items, land, a player-driven economy where value can be earned and traded, and interoperable identities or items that could transcend the game itself. Connecting to a wider, cool Japan metaverse, this model leverages gaming's core loops of engagement and socialization to teach millions of users the principles of digital ownership and decentralized ecosystems in an intuitive, entertaining context. The economic and market implications of such a successful launch are profound. First, it would act as a massive global user acquisition funnel. A hit game can attract tens of millions of active players within months. Each player, by necessity, would create a digital wallet, hold and trade tokens or assets, and interact with blockchain infrastructure, all while being motivated by fun and community, not speculative investment. This represents the holy grail of Web3. Second, it would create a self-contained, high-velocity economy. The in-game tokens and assets potentially tied to or exchangeable with major cryptocurrencies would see enormous daily transaction volumes, generating fees and value that would flow back into the underlying blockchain ecosystem. This utility-driven demand creates a more sustainable value foundation than pure speculation. Third, it would provide irrefutable proof of concept. A successful super game would demonstrate to the world and to hesitant regulators elsewhere that tokenized digital economies can power engaging, large-scale entertainment, thereby legitimizing the entire sector and forcing global competitors to accelerate their own strategies. Therefore, the super game is more than a product. It is the potential narrative apex of Japan's national strategy. The government's cultural mandate, the corporate's infrastructural build, providing the stablecoins and scalable networks, and the clear regulatory environment all converge to enable a single world-class consumer experience. Its launch around 2026 would not occur in a vacuum, but at the precise moment when the underlying support systems are coming online. Success would validate every preceding investment in law, creating a powerful feedback loop. The game's popularity would drive more capital into Japanese Web3 infrastructure, which would enable even more ambitious projects, further cementing Japan's leadership. It represents the moment the meticulously built engine roars to life, capturing global attention and potentially redirecting the center of gravity for the next cycle of the digital economy toward the ecosystem that made it not just possible, but inevitable. The true power of the Japanese thesis lies not in any single pillar, but in their unprecedented synchronous convergence. The final pillar of our analysis synthesizes the preceding points to reveal a holistic and self-reinforcing ecosystem poised for a catalytic outcome. Japan's position is unique not because it possesses one advantageous element, but because it has consciously engineered all four critical elements: strategic vision, industrial infrastructure, regulatory clarity, and a cultural catalyst to mature on a congruent timeline, with 2026 as the focal point. This is a masterclass in multi-year, multi-stakeholder coordination rarely seen outside of wartime mobilizations or space programs. While other regions showcase strength in one or two areas, Japan is assembling the complete puzzle, creating a structural advantage that is extraordinarily difficult to replicate in the short to medium term. This convergence solves the fundamental problem that has plagued crypto adoption: the chicken and egg dilemma of utility. Speculation alone cannot sustain a technological revolution. It requires real-world use cases. Yet, building those use cases at scale requires massive capital and regulatory certainty, which are withheld without proven utility. Japan is systematically breaking this deadlock. The government's cultural mandate provides the compelling why, creating political and social cover. The corporate's infrastructural build provides the how, deploying patient capital to construct the industrial-grade rails. The regulatory framework provides the where, offering a safe, defined legal environment for operation. Together, these three elements create the fertile ground, the runway. The hypothesized super game then becomes the what, the dazzling spacecraft that launches from that runway, demonstrating the utility to a global audience and validating the entire endeavor. The strategic implication is that Japan is effectively creating a closed-loop economic flywheel. Capital, attracted by clear rules, funds infrastructure. Infrastructure enables compelling applications like gaming and digital content. Successful applications drive user adoption and create new economic value. This new value and success justify further regulatory support and attract more capital, spinning the flywheel faster. This flywheel is designed to concentrate liquidity, talent, and innovation within Japan's digital borders, creating a gravitational pull that draws in global partners who wish to participate in, rather than compete with, this burgeoning ecosystem. Major asset managers like BlackRock are not merely observing. They are actively seeking partnerships within this framework, recognizing it as the most de-risked and scalable on-ramp for institutional exposure to digital assets. Therefore, concluding that Japan could influence the next cycle is an understatement. The evidence suggests it is positioning itself to define the narrative and flow of the next cycle. When the broader crypto market seeks a new, sustainable growth narrative beyond Bitcoin ETF and monetary policy, Japan's story of cultural digitization powered by institutional capital and legal clarity offers a powerful and fresh alternative. The 2026 target is not an arbitrary date. It is the projected moment when all these parallel lines of development, from stablecoin rollout and trading house projects to game development cycles, intersect.